Hi there, tax accountants. I hope all is well. And I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 6, Accounting Periods and Other Taxes from Income Tax Fundamentals 2024. So by the end of this chapter, you should be able to determine the different accounting periods allowed for tax purposes, determine the different accounting methods allowed for tax purposes, determine whether parties are considered related for tax purposes, and classify the tax treatment of certain related party transactions, apply the rules for computing tax on the unearned income of minor children and certain students, which is referred to as the Kiddie Tax, calculate a basic alternative minimum tax, apply the special tax and reporting requirements for household employees, also referred to as the Nanny tax, compute the special taxes for high income taxpayers, describe the basic rules surrounding special taxpayer situations such as divorce, deceased taxpayers, non-resident taxpayers, and farmers, and identify significant differences in the tax law for members of the U.S. Armed Forces. So as it relates to accounting periods, almost all individuals, they need to file tax returns using a calendar year accounting period. So a calendar year period is essentially January 1st to December 31st. In addition, we have what's called a fiscal year. So a fiscal year is essentially any other 12-month period. So think of it from birthday to birthday. Not everyone has a birthday that's on, January 1st. So my birthday is July 19th. From July 19th X3 to July 19th X4, that's a 12-month period, but it is not a calendar year. So that's the distinction between a calendar year, January 1st to December 31st, versus a fiscal year, which is any other 12-month period. And again, an easy way to understand a fiscal year is think of it from birthday to birthday or anniversary to anniversary. So for partnership and corporation tax years, many individual tax returns, they include the pass-through income from partnerships, limited liability companies, S corporations, as well as personal service corporations. So in essence, partnerships and corporations, they have a great deal. They have more freedom in selecting a tax year as compared to an individual. It's pretty rare that an individual reports for tax purposes on a fiscal year, but there's no restrictions on an individual needing to utilize the fiscal year. But in the event that, let's say, an individual, they do want to file on a fiscal year, it needs to be made with their initial tax return, and the books and records, they need to also be kept on that basis. Also, the IRS will need to approve it. So back to partnership and corporation taxes, there was a change with tax law when Congress decided that unfortunately this freedom, it often resulted in an inappropriate deferral of tax income. All right, so as it relates to deferral, defer is essentially to postpone, to delay. It does not mean that they'll never pay taxes. It just means that it defers, postpones, delays. So most partnerships, S corporations, and personal service corporations that are owned by taxpayers, they now conform to the same calendar year reporting used by individuals. So these entities, they're allowed a September, October, or November year end if their owners make an annual cash deposit on behalf of the entity or perform other required calculations in order to assure that the Internal Revenue Service, IRS, that they are not deferring any payment of taxes. So we have what's called a short period taxable income. In the event that taxpayer has a short year other than their first or last year of operations, they're required to what's called annualize their taxable income in order to calculate the tax for that short period. So when we're calculating the tax liability for an annualized period, we also have to allocate everything back to the short period. So now with corporations, there's a flat 21% rate. Doesn't matter if they make $1 million, 100,000, 1,000 net income, doesn't matter. It's a flat 21% corporate tax rate. So the annualization method, it's more, somewhat simplified. So here we have this example. It states calculate organic dairies tax for the short period. Organic Daily LLC obtains permission to change from a calendar year to a tax year ending September 30th. For the short period January 1st through September 30th, the corporation's taxable income was $20,000. So solution is step one is we need to annualize the income. So we know that there's 12 months in a year, but in this example, the tax year ended September 30th, so it's the 9th month. So therefore, 20,000 multiplied by 12 months divided by 9 months equals 26,667. So the tax on the annualized income would be 21% times the amount 26,667, which is a total of 5,600. So the short period tax in such case would be the 5,600, and now we divide the 9 months over 12 months. So in order to clear up any confusion here, we're annualizing the income. So we're looking at it this way. Okay, in the first 3 quarters, the first 9 months of the year, they earned 20,000. So what's the projected amount of income that the business would have earned if they ran through the entire year? So that's why in this case, 12 is in our numerator, 12 months, and we're dividing by 9 months, which is our denominator. So this is projecting that Organic Dairy LLC would have earned $26,667 for the entire year. Based on that, we multiply it by the corporate flat tax rate of 21%. And in the event that the company ran for the entire year, we project that their tax liability would have been $5,600. But step 3, since they only operated for 9 months, 3 quarters of the year, they are only responsible to pay 3 quarters of the tax, which in this case would be $4,200. Next, we move on to accounting methods. So the tax law requires taxpayers to report taxable income using the method of accounting that's regularly used by taxpayers and keep in their books, provided that the method clearly reflects the taxpayer's income. So they have what's called the cash method, the cash receipts and disbursements method. That's essentially where a business, they only record revenue when they receive it in cash. Likewise, for expenses, they only record expenses when they are actually paid. Next, we have what's called the accrual method. We know that based on GAAP, generally accepted accounting principles, certain businesses, they have to use the accrual method of accounting. And under the accrual method of accounting, it does not matter when the revenue was received. The revenue could be received before or after the services were provided or the products were sold. Doesn't matter. The key thing under the accrual method of accounting is, did the individual earn the income? If they earned the income, then according to the accrual method, they need to record the income. Likewise, with expenses, it doesn't matter if the expense was paid for in advance, if it was prepaid, or if it is paid for after the expense was incurred. The key thing under the accrual method of accounting is, was the expense incurred? Next, we have a hybrid method, which is basically just a bridge between cash and accrual method. So again, the tax law requires taxpayers to use the same accounting method for tax purposes and book purposes. Taxpayers, they make an election to use an accounting method when they file their initial tax return, and they'll use that method. So cash receipts and disbursements method, this is the method that's used by most individuals. It recognizes, again, income when it's actively or constructively received, and it recognizes deductions, expenses in the year of payment. There are some exceptions. This includes any prepayment of interest as well as any prepaid rent. Next, with the accrual method, again, recognizes income when it is earned, regardless of when it is received, and when the amount of income can be estimated with reasonable accuracy. Recognizes deductions, expenses when they are incurred, regardless of when they are paid, and the amount of the deduction can be estimated with reasonable accuracy. So all activities related to the incurrence of the liability must have been performed. This is what is referred to as economic performance before the deduction, before the expense can be claimed. And it cannot be used for prepaid income, rent received in advance. And again, the hybrid method that is synergy between both the cash as well as the accrual method. The cash method cannot be used by regular corporations. Whenever you hear regular corporation, that's basically a C corporation to make the distinction between an S corporation. Partnerships that have a regular corporation as a partner, tax-exempt trusts with unrelated business income, and some exemptions include farming businesses, qualified personal service corporations, and entities that have an average annual gross receipts of 29 million or less in 2023. So next we move on to related parties, which is governed by Section 267. So when taxpayers who are related to each other engage in transactions, there's a potential for abuse of the tax system, and obviously Uncle Sam is not having that. So in order to prevent this abuse, the tax law contains provisions that help to govern related party transactions. And under these rules, related parties, whenever they undertake certain types of transactions, they might find that the timing of the income or the deduction recognition, it'll differ from the typical rules. So there are two types of transactions between related parties as governed by Section 267 of the tax law. The first is sales of property at a loss, and the second is unpaid expenses and interest. So whenever property is later sold to an unrelated party, any disallowed loss may be used to offset gain on that transaction. And as it relates to this, under the tax law, losses from the sale or exchange of property, whether it's direct or if it's indirect, they're disallowed whenever it's between related parties, right? So next we move on to unpaid expenses and interest. So under Section 267, related taxpayers, they're prevented from engaging in tax avoidance schemes in which the taxpayer uses cash method of accounting and another uses the accrual method of accounting. So as it relates to relationships, Section 267, it has a complex set of rules that defines who is a related party for disallowance purposes. The common related parties under Section 267 include the following: family members, the taxpayer's brothers, sisters, half-brothers, half-sisters, spouses, parents, grandparents, children, grandchildren, corporation or individual who directly or indirectly owns more than 50% of the corporation, two corporations that are members of the same control group, trusts, corporations, and certain charitable organizations. Related party rules also consider constructive ownership in determining whether parties are related. So under these rules, taxpayers are deemed to own stock by certain relatives and entities. Next, we move on to unearned income of minor children and certain students. So a child, generally, they'll compute their income tax liability the same as any other taxpayer, except that the decreased standard deduction is claimed if the child is a dependent. However, sometimes some parents, they find it beneficial from a tax planning standpoint to give their income earning assets such as stocks, bonds, bank certificates of deposits, mutual funds to their minor children. So since minor children, they're generally in a lower income tax bracket, then the unearned income from assets such as interest, dividends, capital gains on stock sales might have been taxed at a lower rate than the parents' rate. But again, Uncle Sam is not having that. So we have what's called the Kiddie Tax. So one of the provisions of the tax law is that certain unearned income can be taxed at the parent's rate if it's higher. All right, so this is commonly referred to again as the Kiddie Tax. So a child is subject to the Kiddie Tax if they're required to file a tax return, the child's unearned income is more than $2,500 for 2023, either parent is alive, the child is under 18, is age 18, and doesn't provide more than one half of their support, or they're between the ages of 19 to 24, they're a full-time student, and they don't provide more than one half of their own support. So there's no statutory definition for parent. The term is generally considered to mean a parent or step parent of the child. So for purposes of determining the child or the young adult's income that's subjected to the parental tax rate, net unearned income is never considered to follow wages, salary of the minor. So the computation is as follows. Start off with unearned income. From there, you'll take the greater of 1,250, which would be the child's standard deduction, or the allowable itemized deductions that's directly connected with the production of the earned income. And from there, you'll get the net unearned income. If the net unearned income is 0 or less, then the child's tax is calculated using the child's tax rate. However, if the net unearned income amount is positive, then the child's tax is calculated by applying the parent's tax rate, if higher, to that amount. So the election to include the child's unearned income on the parent's tax return. So there's a more precise method of describing the computation of Kiddie Tax. It's basically to compute the parent's tax without the child's unearned income and then recompute the parent's tax with the child's unearned income. So if there's more than one child that's subjected to Kiddie Tax, then there's a complex allocation of tax to each child, and they would use what's called Form 8615. And then the taxation of a child's unearned income, it'll become even more complex in situations where the child's earned income is unusually high, maybe over 70,000, or where the unearned income is subjected to preferential rates such as qualified dividends or long-term capital gains. So tax law, again, there's a lot of nuance. It could be fairly simple or it can be fairly complex. Every situation is different. Next, we move on to the election to include the child's unearned income on the parent's returns. So if certain conditions are met, then the parents, they can elect to include in the child's gross income on the parent's tax return. So this election, it basically eliminates the child's return for filing requirements and save the parents from the trouble of having to file a special calculation on Form 8615. So in order to, qualify for this, the gross income of the child is from interest and dividends only. Gross income is more than 1,250, but less than 12,500. There's no estimated tax that has been paid in the name of the child, and the child is not subjected to backup withholding. So this election is beneficial in a number of ways, as mentioned. Now, the child doesn't have to file a return, and it saved the parents from having to file the special Kiddie Tax calculation on Form 8615. So now we move on to the AMT tax, the alternative minimum tax. So there's a small number of individuals that are subjected to two parallel tax calculations. So a lot of times, individuals, they'll say people that make a lot of money, they don't pay enough taxes and things of that nature. But they actually do. We're kind of moving in to the section of the chapter where we talk about special taxes that are imposed on high earning income taxpayers. We often refer to them in the profession as high net worth taxpayers, right? So we have what's called AMT. So as mentioned, a number of individuals, they're subjected to these parallel tax calculations. The regular tax, and then in addition, the alternative minimum tax. So the AMT was designed in the 1960s to ensure that wealthy taxpayers would not take advantage of special tax write-offs, included tax preferences, and other adjustments in order to avoid paying tax. So as mentioned, Uncle Sam is not having that. So with AMT, this basically, requires individuals to pay more in taxes. So we'll look over the calculation here. In general, taxpayers, they must pay the alternative minimum tax if their AMT tax liability is larger than their regular tax liability. So AMT, it is calculated on Form 6251 using the following formula. We start off with the regular taxable income before standard deduction. And then from there, we would add or minus the AMT preferences and adjustments. All right. So just keep in mind the terms AMT adjustments and AMT preferences, they're often used interchangeably, but they do have slightly different meanings. So in general, adjustments, that's basically timing differences, right? That arise because of differences in the regular and the AMT tax calculation. So an example of that would be depreciation. Preferences, on the other hand, those are special provisions for regular tax that are not allowed for AMT. So an example would be state income taxes. So both terms, they refer to items which adjust the regular taxable income in order to arrive at income that is going to be subjected to AMT. So there's a plethora of adjustments and preferences. There's more than 20, and they are on Form 6251. So from there, start off regular taxable income, plus or minus these preferences and adjustments. This gives us our alternative minimum taxable income. From there, we subtract the AMT exemption. It's phased out to zero as the alternative minimum taxable income increases. It equals the amount subjected to AMT. From there, we multiply the AMT rate. We determine what the tentative minimum tax is. We subtract the regular tax. And from there, that will equal the amount of AMT that's due with the tax return if it is a positive amount. All right. So we covered this, some common AMT adjustments and preferences. Adjustments are timing differences. Preferences are special provisions for regular tax, not allowed for AMT. Both terms refer to items that adjust regular taxable income to arrive at income that's subjected to AMT. There's a number of different types of adjustments and preferences used in the calculation of AMT. So some common types of adjustments and preferences: the standard deduction allowed for regular tax, not allowed for AMT. Deductions for property tax, state income tax, other taxes allowed as itemized deductions for regular tax, not allowed for AMT. Depreciation is generally calculated over a longer life from AMT using a different, sometimes using a different method. Net operating losses are calculated differently for AMT and often result in an adjustment. State income tax refunds, not considered income for AMT since the state income tax deduction is not allowed. Interest from specified private activity bonds, not taxed for regular purposes, but it is taxable for AMT. So as it relates to the AMT exemption, the 23 exemptions and thresholds are as follows. So in order to reduce the chances of subjecting a greater number of taxpayers to the AMT, there's an exemption that's permitted against the AMT income. So as we see here, exemption amount, married filing joint, it's 126,500. Single or head of household, 81,300. Married filing separate, 63,250, and then we see the threshold. So exemption is reduced by 25 cents for each dollar by which the taxpayer's AMTI exceeds the threshold. So for married filing joint, the threshold is 1,156,300. Single head of household, 578,150, and the same for married filing separate. So the AMT rates for calculating tentative minimum tax is 26% of the first 220,700, 110,350 for married taxpayers filing separate, plus 28% on the amounts that's above 220,700. The increases in AMT exemptions and thresholds, coupled with the limitation on the itemized deduction for state and local taxes and suspension of the miscellaneous itemized deductions subjected to 2% floor, reduces the numbers of taxpayers that are subjected to the AMT. Next, we move on to what's called the nanny tax. So sometimes individuals, they have persons that are in the household that essentially, help them. So over the years, the taxation and reporting of household employee wages, it caused a lot of problems for taxpayers as well as the IRS. The threshold for filing was low. It was $50 per quarter of wages. And then there were tax forms that needed to be completed. They were a bit complex. So as a result, most taxpayers, they just ignored it. They didn't report it. And as mentioned, Uncle Sam is not having that. So Congress, they came up with this decision to address the issue, and they enacted what's commonly referred to as nanny tax provisions. So these provisions, it helped to simplify it a bit, simplify the reporting process for employees of domestic household workers. So household employers, they're not required to pay FICA taxes on cash payments of less than $2,600 paid to any household employee in a calendar year. But if it's $2,600 or more, then all cash payments, including the first $2,600, is subjected to FICA taxes. If it's more than $1,000 in cash wages are paid to household employees during the calendar year, the household employer must pay FUTA, federal unemployment taxes. So the following workers are not subjected to FICA taxes on wages paid for work in the home. So this would be like the taxpayer's spouse, the taxpayer's father, mother, children if they're under the age of 21, anyone who's under the age of 18 during the year, unless their principal occupation is providing household services. Household employers, they only have to report FICA, the federal income tax withholding, and FUTA tax annually. And just to make sure everyone understands, as it says FICA, this is made up of Social Security tax, which is 6.2%, as well as Medicare tax, which is 1.45%. So when you see FICA tax, that's what it consists of: Social Security and Medicare. Taxpayers, they need to complete Schedule H, and they'll file with their Form 1040. Taxpayers who have a non-household worker, in addition to household workers, they can elect to report FICA taxes and withholding on Forms 941 and 940. At the close of a tax year, taxpayers must file Form W-2 and Form W-3 with the Social Security Administration for each household employee who earned $2,600 or more in cash wages, subject to FICA tax, or had federal income tax withheld from their wages. Next, we move on to additional special taxes for high income taxpayers. Again, that's often one of the complaints that people make with taxes. They'll say things like, those who make a lot of money don't pay a lot in taxes. Not true. So the Affordable Care Act, ACA, it imposes a 3.8% Medicare tax on net investment income of individuals with modified adjusted gross income over $250,000 for joint filers, or $125,000 if married filing separate, and $200,000 for single filers. So investment income subjected to the additional 3.8% includes interest and dividends, royalties, annuities, net rental income, passive activities, and most gains on the sale of capital and other assets. Investment income that's not subjected to the 3.8% tax includes any tax-exempt interest, excluded gain on the sale of a principal residence, distributions from retirement plans and individual retirement accounts, wages, and self-employment income, which is considered earned income. Deductions that are allowed in arriving at net investment income subjected to tax includes state income taxes that are reasonably allocated to the investment income, investment interest expense. So the $3,000 net deduction allowed for capital losses in excess of capital gains for regular tax purposes and net operating losses. They are not allowed to reduce the net investment income. And the net investment income, it's reported on Form 8960. There's also a 0.9% additional Medicare tax on earned income. So the ACA imposes a 0.9% Medicare tax on earned income of joint filers that have earned income over $250,000, $125,000 if married filing separate, and single taxpayers that earn over $200,000. So this 0.9% additional Medicare tax is reported on Form 8959. So for employees, the 0.9% Medicare tax must be withheld from employees with a salary that exceeds $200,000, whether they're single or they're married. And the withholding is reported on their Form W-2. For self-employed taxpayers, the 0.9% Medicare tax must be paid with Form 1040. The following additional rules apply to high-income self-employed taxpayers. The 0.9% Medicare tax, it's not allowed as a part of the deduction for AGI that's attributable to self-employment tax. For married individuals, a loss incurred by one spouse may offset the income earned by the other self-employment spouse for purposes of the 0.9 Medicare tax. And losses from self-employment are not allowed to offset salary or wages for purposes of the 0.9% Medicare tax, because again, Uncle Sam is smart. There's a lot of people that would try to intentionally create losses in their business to avoid or evade rather paying that. And again, Uncle Sam ain't having that. So we move on to some special taxpayer situations. So there's errors that take place, right? You file a tax return and maybe individual realizes, hey, wait, I forgot to include a form, or I forgot that I received this K-1. Things happen. So anytime there's tax return errors, it can be fixed. So let's say a taxpayer that doesn't receive a Form W-2 or 1099-R, the first thing they should do is contact the employer and the payer. And if they can't obtain a form, they'll contact the IRS for a substitute form. The great thing is in this day and age, a lot of things are, technological. They're online in the cloud. So a lot of times you can log into ADP, Paychecks. You can log into the brokerage company and you can, pull the forms from right online. So in the event that, again, they can't find a form or the taxpayer didn't receive it for whatever reason, reach out to the employer to pay her first. And then if not, reach out to the IRS. If there's an error on a Form W-2 or 1099-R, contact the payer to get a corrected form. Taxpayers who file a return using incorrect data, they must file an amended tax return. As it relates to divorce and separation, unfortunately, whenever you file a tax return, and it is a married filing joint tax return, that essentially means that both the taxpayer and the spouse, they are agreeing that they are jointly and severally liable for that tax liability, right? So sometimes, in my firm, there's clients who the taxpayer works and the spouse doesn't. Now I have to let them know, be very aware, okay? The spouse does not work. So this really isn't the spouse's liability, but you're, filing jointly. So God forbid something happens, whether it's a divorce or death, the spouse, even though they didn't have any earned income, they are still liable. So that's a lot of times why, even though, it might cost more, the tax liability works out to be a bit more. Some married folk, they just don't want to file together, right? But in the event that someone has filed a joint return, there are 3 types of relief from joint liability. We have what's called the innocent spouse relief, separation of liability relief, and equitable relief. So the dependent children will usually be claimed by the custodial parent, but they can be claimed by the non-custodial parent if certain requirements are met. Death of a taxpayer. When a taxpayer dies, a final return needs to be prepared. They'll use the same accounting method the taxpayer was using. Income might be allocated to the decedent as well as to another taxpayer as income in respect of a decedent. This is referred to as IRD. Deductions are allocated along with income. The final tax liability is forgiven for an armed forces member or astronaut that's killed in the line of duty. Next, we move on to non-resident and international issues. So taxpayers who are in the U.S., or taxpayers rather who are U.S. citizens, green card holders, or meet the requirements of the substantial presence test, they are treated as tax residents for income tax purposes. Because again, if you come to the U.S. and you're making money, they want to get a piece of the pie. Non-residents, they have a different income tax regimen in the U.S., but they still have to file a tax form. It's called the Form 1040-NR. U.S. persons, they're also required to report any financial interest or signatory authority over a foreign financial account, because a lot of times you will hear of people, they have a lot of money, overseas. Uncle Sam wants to know about it. Reason being, gross income under the tax law, there's no like statutory definition, but what it means is income from all sources, with no regard to where it was derived. So I'm a U.S. citizen. If I have income in Guyana, income in South Africa, income in Asia, all of that income needs to be reported on my tax return. Uncle Sam knows that sometimes as humans, we're dishonest. Therefore, that is why they put these provisions in place, and an individual will need to file what's called the F bar. And if the F bar is not filed, there's some extremely heavy penalties and fines. Next, we move on to farmers. So according to the U.S. Department of Agriculture in 2020, there's over 1.7 million family-owned farms. Farmers, they have a special form, Schedule F under Form 1040. And there's lots of provisions for farmers, and this makes it a specialty area of taxation. Lastly, we move on to military taxpayers. So the tax law provides certain tax advantages to active members of the U.S. Armed Forces. The U.S. Armed Forces includes commissioned officers, warrant officers, persons that are enlisted. And here we see they receive basic allowance for housing, basic allowance for subsistence. Other allowances that are excluded, they include clothing allowance, dislocation allowance, family separation allowance, family supplemental subsistence allowance. The pay that they earn while they're assigned to a combat zone is also excluded, and any disability severance pay that's associated with a combat-related injury or otherwise classified as disability compensation, that is also excluded from gross income. All right, so this brings us to the end of the chapter. There's a lot of new concepts and things that we've covered. Some of these things you might never see in the profession. Some of them you might, right? Again, the tax law is so vast that it's impossible to know every area of tax law in depth, but it's good to at least have a basic understanding. And if you are presented with a situation with a client where one of these things apply, refer to the publication, do some tax research, and refresh your knowledge. So now that this lesson has earned, you should have learned how to determine the different accounting periods allowed for tax purposes, determine the different accounting methods allowed for tax purposes, determine whether parties are considered related for tax purposes, and classify the tax treatment of certain related party transactions. Apply the rules for computing tax on the unearned income of minor children and certain students, referred to as the Kiddie Tax. Calculate a basic alternative minimum tax, apply the special tax and reporting requirements for household employees, referred to as the Nanny tax, compute the special taxes for high-income taxpayers, describe the basic rules surrounding special taxpayer situations such as divorce, deceased taxpayers, non-resident taxpayers, and farmers, and identify the significant differences in the tax law for members of the U.S. Armed Forces.